Let's talk the big picture. Nate Peterson joining us, Director of Derivatives Analysis at Schwab's Center for Financial Research. We got a split market here, Nate, but the Russell faded pretty hard from earlier this morning. That does seem to be the most fickle of our stock market groups.
Yeah, got yields higher, Oliver. So it's just, with the Russell and yields, you just think there's that inverse correlation. If you look at the performance of technology in the face of rising yields, largely pulled by that mega cap tech, locomotive there. Tech is shown, or mega cap tech is shown that is the place to go if you're looking for the growth. Look at the EPS estimates. If yields are rising again, the money tends to come away from those rate-sensitive areas of the market, utilities, real estate, small caps, etc. And then it goes back to tech. And then tech is really kind of backing it up. If you look at the pre-announcement from a company like a super microcomputer, they get the NVIDIA chips. If you look at Taiwan Semi and their guidance, it wasn't gangbusters, but better than expected. So the fundamentals are there to kind of back up that reasoning, that thesis in terms of going into tech as a safety trade. And, we're in price discovery mode in a sense, with the S&P at new all-time highs, NASDAQ 100 all-time highs, Dow Jones all-time highs. When you're in price discovery mode like this, in the face of not having anything that's seen as detrimental to dent that thesis, then the path of least resistance is higher. But Oliver, as I look at this setup here, we got Netflix tonight. Next week, we're going to really be hearing from mega cap tech. We got a 73 RSI in the NASDAQ 100. As we get through next week, I think Apple reports on Thursday after the bell. I believe that's the last of the big mega cap tech to report. I think you got to be cautious. If we continue to melt up into these mega cap tech reports, if they're good, even if they gap up, number one, you're likely going to be stretched on the RSIs. You'll be overbought. Number two, the catalyst for getting into mega cap tech prior to earnings, that catalyst will be off the table after they report. And then February, over the past 20 years, is the worst performing month for technology. So for our tech traders, watch out when you get past Apple earnings on Thursday. You can't really time this. I don't have a crystal ball, but if that setup does play out like that, I think you got to watch out for maybe some volatility in tech in February.
Yeah, it seems like obviously our bar is higher the further valuations run. There are some exceptions to this where the earnings growth has been so extraordinary that the valuations haven't blasted off, but they're few and far between, basically limited to NVIDIA. Everything else has gotten significantly more expensive. So the earnings now have to at least meet. It kind of seems like this should be a quarter where any misses get punished.
Yeah, I mean, it's going to be, that's part of the thesis. If you look at GDP estimates, they have been coming up. So you think that ties into corporate earnings. If you look at technology and their guidance and what they've been reporting, that seems to be in place. I really think technology was able to pull the S&P out of this kind of doldrum sitting below the 4,800 resistance level. The S&P, the technology really pulled that above there. So the question, I think, as a trader, you have to step back and ask from an intermediate term basis is, if technology continues to kind of generally over time march higher, is that enough to kind of lift the overall tide? And I think the answer is probably yes. Will there be volatility and corrections along the way? Yes. In the meantime, we got the Fed that is supposed to be moving into accommodative mode. If you look at the probabilities, they were above 80% in terms of a March rate hike cut maybe 3 weeks ago. Now that's down to about 48%. Nothing unusual. We've seen this before. The market expects the Fed to be more accommodative than it is. The probabilities back off, and that seems to be the case. But inflation is cooperating. We get PCE prices on Friday. That could be a boost. We're going to get GDP advanced read on Thursday. Maybe that comes in better than expected. I still think good economic data is going to be good news for the bulls. Ultimately, if you look at the fact that the economic data has been better, that has translated into rising yields, and yet we're at all-time highs on the S&P and the NASDAQ 100. You have to tie in that correlation and say, good news is net good news.
All right. Yeah, big tech acting as the safety trade. I like your point about the Russell being more sensitive to rates. Certainly makes a good bit of sense to me. Thanks, Nate Peterson, for the thoughts.